Hello and welcome to our interview series where we bring you valuable insights from fund managers across leading AMCs. Joining me and my colleague Chirag today is Ihab Dalwai. He's fund manager at ICICI Prudential AMC. Welcome, Ihab.
Yeah, hi. Thank you for having me.
Good to have you back with us. Now, to begin with, given the current market landscape, do you expect the ongoing volatility to subside soon, or should investors brace for extended fluctuations? What's your view there?
See, it's broadly important for us to understand how this volatility has arisen. Like, what's the cause of this volatility? I feel that it's broadly because of global factors or global macroeconomic, or maybe because of administrative change in US, resulting in this volatility. As and I think as and when those issues subside, and I think till those issues subside, I feel this volatility may continue. Second important thing to note is that it's important to see it in relation to what valuation Indian markets are trading at. The valuation at which, especially mid and small cap, are trading at. I think volatility would be here to stay because of the relatively higher valuation, and because of certain global uncertainty from a macroeconomic and administrative change perspective.
What are the key factors do you believe will drive the Indian economy recovery in the equity markets in the coming months?
See, one of the key drivers for market recovery or earnings, or for equity returns, has been earnings. So what we have seen post-COVID recovery is that we've seen a strong earnings recovery. So as a result of which, markets have also delivered. The confidence of investors is also high, which has resulted in the multiple re-rating as well, with earnings coming in. What we've seen, especially over the last 2 quarters, is that there have been certain earnings misses. So markets' expectations were ahead of the actual delivery of earnings. And as a result of which, the investor sentiment has also taken a slightly has taken a bit of a backseat currently. So as a result of which, we're seeing some market correction currently, primarily driven because of the earnings miss plus the global uncertainty, which I spoke about earlier. Yeah.
So that the earnings should improve going forward. That will be one of the trigger for the markets to go up.
Yes. And for earnings, I feel what we have seen, especially over last 2 to 3 years, is that a large part of the earnings has been delivered by margin expansion across various sectors or segments of the market. Going ahead, the headroom for margin expansion is to some extent limited. So what we need is an actual good growth in or recovery in top line, which would ultimately be dependent on how government spending shapes up, how actually corporates start spending or investing to increase capacity, and also how the retail or the households start spending. Because of late, what we have seen is that the household, to some extent, is in a bit of a balance sheet repair, or I would say has decelerated in terms of the credit impulse of an household, is what we've observed, especially in the retail credit side. So broadly, all three segments of the spending or of the economy have to some extent slowed down, which as a result of which the top line is also not coming in as what market has been expecting, and the headroom for margin expansion is low. I feel this is a temporary blip. I think it's not something which we're seeing a structural issue in the ability of all these three participants to spend. There can be some trigger here and there can activate or can kickstart the spending from all the three segments of the economy.
All right. Now, Ehab, moving on, could you share your core investment philosophy with us and how it adapts to different market cycles, especially during periods of high uncertainty?
See, broadly, my thought process of investing is trying to identify segments or pockets of the market currently not, I would say, liked by the market, or that segment of the market is undergoing certain issues or temporary issues, I would say, but the medium to long term fundamental story of those company or segment of the market is intact. It can be classified as a bit of a counter cyclical or a non consensus style of investing. So my hunt always has been to identify those segments of the market which today may be under-owned, may be disliked by the market, may have underperformed on a 3-year basis. So that is broadly my hunting ground. I don't want to bucket it into either a growth, quality, or a value style, but I would be open to invest in either of the three segments. But my starting point of the hunting ground is underperformance, under ownership, segment of the market going through some temporary stress. Because I feel having this approach or a starting approach provides you a good margin of safety in terms of the value of business and the price which I would be paying to buy those businesses.
Apart from that, what are the other filters which you look for the stocks apart from this key ingredient before zeroing the stock?
Yeah, so see, broadly, like people try to bucket it into value, growth, and quality. I feel that one has to have a blend of all three in terms of if I'm buying a value stock without a growth, I think growth is a key trigger for the stock to do well. But if I'm buying a growth stock expensive for it to deliver prospective return is difficult. Uh, and ROE as well. Like if there's a high ROE business but doesn't grow, for it to generate return is difficult. So I think all the three have to be there. Like it's not right to buy a very low ROE business because ultimately, as much as even if it grows pretty high, if it is not higher than cost of equity, that growth has no value. So I think it's important to give importance to all the three. Keep all the three in mind. But I would say my style is more towards the price which I pay. So it is important that I shouldn't be overpaying for either the growth or the ROE which I'm buying today.
What are the non-negotiable criteria in a company or a stock which must meet to make it into your portfolio?
See, for us, we being minority shareholders in most of these companies, because to a great extent we can't influence the operating performance of these companies. So management or promoters or significant owners of the company should be fair towards minority shareholder. I think even if there have been historical track records of company not being fair to minority shareholders, I wouldn't want to be a part of that company's growth story or the investment journey. So being fair to minority shareholder is very important. I think second criteria is capital discipline as well. Doing good capital allocation decisions, be it being a returning part of the earnings back to shareholders, doing prudent allocation of capital. So that is also important when assessing a business or a management.
Right. Now, moving on to your perspective on sectors, themes, and market trends. So, Sankaran Narayan, he recently mentioned that quality stocks are looking attractive after a period of underperformance. Do you share this perspective with him? And do you see quality investing as a key theme moving forward?
So the initial framework or the setup which I spoke about, that it has to be an underperformer on a 3-year time frame. It has to be something which the market segment should not be too keen interested in. I think most of those check boxes, like tick boxes, has been done for those for quality as a style because I think it has underperformed on a 3-year time frame. A lot of these businesses which are high on ROE, like quality, I would say that high ROE is would define quality as a space. That segment of the market has not re-rated. Would see that most of the other segment of the market has re-rated, but quality as a segment does not. Within that, I think IT has software services has re-rated, which fits into the quality basket. But outside IT, I think there are a lot of segments of the market which is not re-rated. And I think being associated with quality stocks today has hurt fund managers if they've been invested for 3 years. So I think the existing holders would be under stress from a performance perspective also. So for me, for anyone who's looking at quality today, I think it's a good entry point because I'm not carrying the baggage of underperformance of quality stocks. So if I'm trying to enter it today, I'm getting these businesses. May not be at a very cheap valuation, but I feel relative to the market, I think it is a fair valuation to be associated or be invested in quality stocks today.
Yeah, given the current market scenario where we have seen correction since November, December, and even in the for few days of January, which are the segments you think which are overvalued at this point of time, and which are the segments which you think are having the attractive opportunities?
See, I think because market has been buoyant, there have been a lot of these stocks in the market which to some extent have demonstrated historical growth uh, and are promising for growth going ahead as well. But the ROE profile of those businesses are not that great. It is an expectation of the market that eventually ROEs or profits will come higher than cost of equity. I think market has re-rated that segment of the market. So I would say that in growth also one can divide it into decent ROE businesses which generate decent profitability and are growing. I think that segment is fine. But there is a segment of the market which is growing very fast or promising to grow fast, but the ROE profile is to some extent absent. So I would not be associated with that segment of the market. From a cyclical perspective, also, I think to some extent, residential real estate also, I would say, is in an upcycle. Generally, I wouldn't want to be invested in stocks which are in upcycle today. It's not that we have not been positive on residential real estate companies. In the down cycle, I think our house had launched a housing fund also, which can invest in various segments of uh, uh, the industry which associate themselves with the housing industry. But that is the segment of the market which may do well going ahead also, but that is not something which I would want to enter in today.
But yeah, if we look at the small and mid cap segment, which has corrected a lot, what's your view on the small and the mid cap segment? Do you see more pain going forward there too?
See, I think it has to be seen in a relative lens versus where the large cap valuations are. I was seeing a data which said that Sensex has underperformed gold on all time period, on a 5 year, 10 year, 15 year, I think on a 20 year time period also. So if I'm getting these mega caps at a relatively underperformance to even an asset class like gold, I think the margin of safety is significantly higher in that segment of the market today. Secondly, like I mentioned, obviously mid and small caps have had a better earnings growth profile versus large caps, and that's why they've done well. But they've also re-rated to a great extent. So when earnings, I think, moderate or the earnings growth moderates, I think there is a possibility of multiple compression, higher probability of multiple compression in mid and small caps. So from a relative basis, I would be more inclined towards mega caps and large caps versus mid and small caps in today's market structure.
Even if the valuations of small cap and mid cap I mean, appears to be higher compared to the large caps. If you want to invest, then how do you go about investing in the stocks which are highly valued?
Yeah, so I look after the large and mid cap scheme as well. So there I mandate to invest minimum 35% in mid caps. So to find mid caps to make that 35 or the minimum requirement of allocation, I think there are opportunities within the mid cap space for the 35% of the allocation which I have to make in large and mid cap. There again, I use the similar filter which I mentioned earlier. It has to be something which is currently going under certain stress. So, though I mentioned earlier that most of the margin expansion in the broader market has taken place, but there are pockets in the mid cap space also, where currently the companies are going through certain turn or the margin expansion is yet to play out. There are 3 year underperformers within the mid cap space as well. So I think there is opportunities within the mid and small cap space, but the point I'm trying to make is that there are limited opportunities. I'm not saying there's no. It's like one has to not be invested at all in mid and small cap, but the opportunity is there.
Right. So we have seen reduced exposure to mid and small caps in your ICICI Pru Balanced Advantage and multi-asset funds as well. So is this a valuation-driven shift, or does it reflect broader market trends favoring large caps?
See, broadly, when we go about reducing the allocation to a great extent, it is more of a bottom-up thought process as well. Because internally we do maintain fair values for the stocks which we own. And generally, when the stocks start trading above 1 year or even slightly longer period fair values, uh, it gives the fund manager a trigger, or it hints the fund manager that they have to reduce exposure. So generally, I think it is more of a bottom-up stocks which we have had held in the portfolio, mid and small cap stocks, where I think these stocks have crossed the 1 year fair value or are trading higher than the medium term fair value as well. So it is more of a bottom up approach we've done. We've reduced exposure rather than take a very harsh top down view saying that we have to aggressively reduce those mid and small cap exposure, because the reduction of exposure also would be a gradual process. It's not that something we've done it over a month or two, but because as markets kept going up, the fair value, the stocks started trading above the fair value range. So it was more of a gradual reduction which we planned.
Yeah, if we look at 2024, categories like equity, debt, commodities all did very well, which was very surprising.
Correct.
So how do you look at this multi-asset space shaping up in 2025?
Yeah, clearly. So I think it was a very unique year where like all the three asset classes have done decent. So I think going ahead, clearly it's difficult to call out a winner in terms of the three asset classes. All the three asset classes have their triggers in terms of a possibility of a lot of factors which can generate returns for all the three asset classes, be it a rate cut for maybe debt, or be it US treasury rates coming down for gold, or maybe earnings pick up for equities. So there are triggers for all the three asset classes. Uh, our strong or core belief is that we have to do asset allocation dynamically amongst the three asset classes. So I feel one will have to be tactical approaching the three asset classes. Like I mentioned in the start of the conversation, there will be volatility this year. The expectation is that there would be volatility. So dynamically managing allocation amongst three would be the key, rather than having a static allocation to each of the asset class.
Okay, and funds like ICICI Prudential Balanced Advantage Fund, they have faced challenges during bullish market conditions, as the model suggests, reducing equity exposure. So, how do you envision this strategy evolving, and especially if the market undergoes more correction?
Yeah. So the balance advantage fund, the broad setup of the fund is a counter-cyclical approach. Like if market goes up, it reduces the net equity level, and as market have been correcting, the net equity level is expected to go up. So we are comfortable with that broader framework of managing the asset allocation within the balance advantage fund. Uh, what I would say was missing all this while was a bit of volatility, because this product has been designed to generate return in volatile environments as well. And historically, if you look at the track record of this fund, it does well in a volatile environment. So if expectation is volatility to come back, I think these products should do well, like Balance Advantage Fund, which are dynamically managed, follow a set process of managing the net equity level. Those funds should do well. In an upward trending market, generally, I think this fund would end up giving decent returns, but may not end up satisfying the investors' expectation as good as what a fully invested fund would do. Yeah.
Yeah, we spoke about the multi-asset fund, but what is your view on the investment case for the multi-asset fund given the current market scenario?
So, like I mentioned, similar to Balance Advantage Fund, volatility is expected. So, multi-asset fund is also dynamically managed, similar to a Balance Advantage Fund. The ability for us to toggle between the three asset classes is also quite high, and better position to do it for an individual in the current framework which we have. And we believe in dynamically managing it. So I think that is also a reason why we feel in a volatile environment, both these funds, frankly, both Balance Advantage and multi-asset fund should be the preferred choice for an investor.
Yeah, now if we come specific to the large and mid cap fund, it has performed well over the period of time. though its performance margin compared to its peers have moved a little bit narrow since 2022. What have been the key drivers behind the performance?
So, see, broadly following a disciplined investment process is important, is what I feel, and rigorously applying it across sectors of the market. I think that's what we've tried to do in this strategy as well. What is yet to play out, I would say, our preference of large and mega cap versus mid cap. I think that's how our product is positioned currently in the market. That is yet to play out. But to a great extent, the sectorial calls have also played out. I would think last year or slightly before that, we've had a preference towards autos, a preference towards pharma. Couple of years back, I would say the preference was towards PSU in this product. So all those top-down sectorial calls have also helped, coupled with the bottom-up stock pickings, which has also helped. So I would say broadly, it's sectorial calls plus the bottom-up stock picking and diligently sticking to the investment framework which we've adopted for this strategy.
But yeah, if we look at for example, if we look at the period of 21-22 compared to 23-24, the margin has narrowed, the outperformance compared to the peers. So what has led to that? It has no doubt it has done well, but the being in the quartile 2 or 3 compared to quartile 1, what was the reason for that?
Yeah, so if you see the near-term performance may have taken some slight dip is because of the preference towards large caps versus mid caps. I think peers would be higher index towards mid caps. And last 1 year, I think the outperformance of mid cap versus large cap is to some extent stuck till I think December and performance. So I think that has been one of the key contributors. Secondly, like I've been saying that the portfolio has been repositioned towards more quality stocks, which over the last, I would say, 6 months, which haven't done as well as the broader market. But this is a positioning which I have done today or like over the near term, which is something which I expect to do well going ahead. So I think that repositioning was also to some extent may have hurt the near-term performance. But I think if you look at the longer-term time period of maybe a 3-year performance, I think this fund has still done relatively better versus the peers.
Okay, and when it comes to over the past few months, the fund has demonstrated strong downside protection, falling the least among its peers and the benchmark. So, what contributed to this resilience?
So from an investment thought process, I'm a big believer that if you buy into stocks which have less expectation and are undervalued. I think if these two key ingredients are there in the stocks which you've bought, I think it provides a very significant downside protection. Because when there are low expectations, the probability of earnings downgrades are low because there is no expectation of growth or any delivery from that company. And when you buy it up or top it up with an under-owned or under the radar stock, there isn't enough ownership in the stock for the stock to correct. So when you have this combination of under ownership and less expectation or pessimist expectations from the stock, I think they provide a very good downside protection. But obviously, like for when I build position in these stocks, my expectation is that this stock would deliver, which can result in earnings upgrades or positive surprise to the market, which will lead to the positive reinforcing cycle in terms of earnings and multiple expansion also.
We have also noticed, nearly 35 to 40% overlap between the large and mid cap fund and the flagship ICICI Value Discovery Fund. At ICICI, how do you manage the portfolio overlap?
So I think 30-40%, I think you would generally end up having it across most of these schemes because of ICICI Prudential, because ultimately the research is common, right? Like a research base is common. So even if I'm buying something in an IT sector, it would generally would be the stock which the IT analyst is recommending. If I'm buying something in the auto sector, it would be something what the auto analyst is recommending. So there would be an overlap, but I think I would see the other way around. 60% of the portfolio is different. So in spite of having a common research pool, if we are able to differentiate 60% of the portfolio, I think that is also, I think it's a differentiated offering to the end investor.
All right, it's time for us to wrap up this chat. Thank you, Ihab, for taking the time for this interaction. It was good talking to you.
Yeah, thank you so much. Thank you.